Okay, and we welcome Eric Harding, and I'll let him introduce himself. Eric, over to you.
Hey everybody, my name's Eric Harding. I have a little bit of a cold if I sound a little bit nasally, but it's on the tail end of it, so hopefully we're good. I work for an options market maker. I've been working at Blackage Capital for a couple of years. I don't have a real strong agenda for what I want to talk about. I've popped into a couple of these meetups in the past, but I don't know you guys. You guys don't know me real well. So like I really have got like 2 slides here. So if you guys don't participate, this is going to be a short talk, or it's just going to be me rambling. So definitely, like, if you got questions, speak up. If you ask me something that I don't know, then I'll tell you I don't know. So yeah, hopefully we'll find some stuff that you guys are interested in. This is the list of topics that me and Don worked on a little bit, stuff we thought might be interesting. But again, like, ask questions, because I'm happy to tell you about my experience, in any way that is interesting to you guys. So my own history, I came at this. So I, graduated from Virginia Tech. It's not that far from here. Went out to Microsoft for about 7 years in Washington State. Got married before I went out there, so I came back because my wife hated the rain all the time. And I got in touch with a market maker down here called Blue Capital Group. They were kind of an interesting group. One of the founders really liked North Carolina, so all their traders were in Chicago, and all their tech folks were down here in Chapel Hill. So I joined them. They shut down about a year after, and the tech team sort of folded that technology in internally and tried to become an ISV, where we sold basically sort of an off-the-shelf system for other options market makers. Some of the traders from BCG went and used it for several years. We did that for about 7 years. It was a pretty tough business being an ISV. Especially in the early 2010s, volatility was at record lows, and a lot of people were going out of business. We pivoted to futures. That didn't work out so well, and so then I decided the writing was on the wall and moved on. So now I've been doing Black Edge since 2020. And yeah, it's been pretty fun adventure here. I've spent a lot of time working on the hedger, really understanding how we hedge our deltas, as well as working on a system to record all the market data coming out of the exchanges. And when I say all the market data, I mean not just the trades, but also all the order updates, all the price updates, pretty much everything. And I'll talk a little bit more about that later. Yeah, so I've also, we're kind of, this is a good time to talk about trading related jobs, stuff like that. Well, let me see, talk about hedging, talk about delta and gamma, and yeah, trading technology. I am foremost a technologist, right? Like, I work with the traders all the time, but the technology is where I come from. So, that's where I'm going to be able to answer your questions in depth. But I can talk about the other stuff too. All right, I just did all that. I'm running out of slides fast. Oh, here we got questions. All right, so here's a question from Rahim K. Since you're working as a market maker, I'm curious on your thoughts about max pain theory. There are several websites regarding this and some YouTube channels. High-level idea is that stock pricing is pushed up or down, so most of the options expire worthless, and thus max pain is inflicted on options buyers and options sellers win. This is the first I've heard of this theory necessarily. I mean, in terms of looking at our position, like we're both a buyer and a seller of options. So I don't know that we necessarily have a particular side that we would care if it wins. Right? We're trying, the name of the game is to reduce risk and be hedged at all times. Does that kind of answer your question?
I can also add, if I may, that to Rahim, That's a very good question for the next talk in the second half of the meeting, because he has his own perspective on why exactly prices move and where they move. So please ask that again in the second half.
And I think just from my perspective, just having, coming from the market maker side and seeing this next talk is going to be really interesting, because it's sort of analyzing the behavior of market makers in a scientific way.
Exactly right.
All right, so how can one make regular passive income on the options market? I don't have an answer for that. I don't trade options myself. I support the company trading options. In terms of my own trading, I'm a pretty simple index fund kind of guy.
See, I can just comment briefly on that, if I may. The market makers do not ordinarily, I think, seek to make money from.
We're not taking bets on directional movements, I guess is another way to say it, right? Like we're providing a service of creating options, buying and selling options for the larger market, but we're not trying to take a positional market for the position that's going to have we're not taking directional bets on the market.
Now there's another form of proprietary trading where the trader or the dealer does attempt to take positions, and that, I think, is what Steve, you're referring to.
It's interesting, Steve, your question about prop traders. So like we did for a couple of years, we tried to make a product competitor to TT for professional prop traders. And it was very interesting to see, sort of like, I didn't have a whole lot of visibility into how they worked, but it was interesting to see, just in terms of from the lens of us licensing software to them, how the individual prop traders had some control over, what software they were using, how they set things up. A lot of times they were underneath other umbrella groups. So I can't tell you if that's typical or what their alternatives are, but it was interesting seeing that the variety out there in the market for that sort of organization.
Yeah, there's some other comments on there now.
Yep, I'm sorry, I'm going quiet as I'm reading through them. Yeah, thanks, Raheem, for the comment. Yes, both buyers and sellers. Yes.
And by the way, that's a beautiful comment that Raheem has made once again. And market makers are short puts and long calls. Generally, that's a major theme for the talk in the second half too. So stay tuned for that.
So Brian has a question about how the hedging might change based on the time of day. For the most part, not really. Like the time of day is not, at least in our hedging, an input to the formula. I mean, we were looking at the market width and the liquidity. And so yes, volatility comes into it in terms of how we compute the valuation of the futures, but time of day, not specifically.
Because you have to make, the market maker has to make, with rare exceptions, has to have both a bid and an ask on every strike in every market at all times. Is that correct?
I mean, it's not every strike on every market, but like the exchange will I mean, if you're supposed to cover a certain percentage of the market for you get certain, I mean, there's quotas, right? Like if you cover a certain percentage of the market, certain both time in the market and number of strikes that you're covering are both important.
And you can do also, there's an RFQ, right?
Yeah. And we track our RFQ response rate, and the exchange tracks an RFQ response rate. And some of that goes into various fees and bonuses that you get as a market maker.
Which means you can request any trader in theory can issue an RFQ, and the market maker has to, within limits, as you say, at a certain percentage, and make a market in that right away.
Yeah, and it varies a little bit between the different exchanges. CBOE will actually run out an auction to kick off the RFQ process, which has been, we moved into the CBOE about a year ago. And that was kind of an interesting exploration there, because those bids and asks are not immediately visible during that brief auction period.
And for those who don't know, CBOE is what major products?
SPX and SPXW and the VIX.
And the individual
and a bunch of other stuff.
Options, which you don't do, is that right?
That's right. We're primarily SPX, SPXW. We're not even actually trading VIX right now. As a market maker, what factors influence your bid and ask spread? I don't know that I can answer that real well. The traders, they've got real-time UIs that are monitoring volatility and stuff like this. So, obviously if volatility is high, they're going to widen things out. But a lot of the inputs that to widen, how much edge we're looking for is coming directly from the trader.
Does your system also input into that?
Yeah. Mm-hmm. Are market makers required to post quotes on both sides of the market, bid and ask? Generally, yes. I think for the most part, if we're in a market, we're generally on both sides. That doesn't mean that, they don't have to be tight necessarily. And I think, like for the CBOE has a fairly high minimum amount of, as we're moving into a new market, we actually ran 2 different quoters for a while, where one quoter would have really wide margins and put quotes, quite a ways out, which we didn't necessarily expect to trade very often, but it fulfilled some requirements. And then the stuff that we were looking at more closely or felt we had a better handle on would trade with tighter spread. Yes, we definitely use futures to manage our risk. In addition to hedging our option position using futures, we have in the automated system, we have something called a futures first order, which is if a trader wants to put in a positional order in the options market, they can tie it to a future, and we'll execute the options trade conditional if we're able to get the future fill first. So you can kind of do it either way. See if I have another slide here. Happy to keep answering questions, or I can kind of move on to the onto my next slide. Let's see. Yeah, in terms of jobs for traders and trading infrastructure developers, obviously I can talk a lot more knowledgeably about the technology side of things, but I think in terms of technologists, there's almost 2 different camps of technology folks. There are folks who really care about trading and technology as a means to an end, and there's folks who care more about technology and don't care as much about the trading. The nice thing, there's a lot of technology people who really just want to solve very interesting problems, and trading has tons of those. Whereas I guess the ones that care more about trading, it's definitely very math heavy. I guess that's more of the quant side of things. There's almost a continuum there, where you've got some folks who are really, sort of pure traders about understanding the market, and some folks who are doing back testing and analysis of the market to see new opportunities. And you can actually do pretty well if you really only care about the talent. You do need to understand the trading, but it's a very deep amount of technology there also. In terms of stay in the triangle or move, this was interesting because, a few years ago, I was, looking for trading jobs or looking for technology jobs coming from a market maker. And yeah, there's not a lot of that kind of jobs in this area, but more and more things are going remote. I think I was talking to a recruiter. This is in 2020, like July of 2020. And, I was talking to places who were saying that we don't do remote. And I think the recruiter was like, these people are still advertising, we don't do remote jobs. And they've hired people that have been in the office for 6 months and they have not been in the office for 6 months since they hired them. So they're doing remote, whether they know it or not. And so it's been sort of a slow progression where I think that, in the last few years, remote work as a software developer, even in, trading was not one of the first ones to jump on the remote work bandwagon, but I think it's definitely growing over time and it's definitely there. So yeah, like I don't see any reason why you would have to move for Black Edge Capital, specifically for college hires. We're asking them to come into the office for the first, I forget what we said, 6 months or a year after they've graduated. But that's also really because new hires right out of college, there's a little bit more volatility in the kind of people that you're hiring, and so having them on site where you can actually like sit next to a trader and understand the business aspect of it is important. We do a pretty on new hires, especially from the tech side, we do try to spend a fair amount of time on training, and shadowing some traders and seeing how they use the software, because understanding how to value an option on paper, because that kind of understanding definitely pays dividends, because if you understand why the system works the way it does, you can improve it. Career security outlook. It's interesting. I guess there's just a bit of an economic downturn now, and a lot of the big tech companies are laying off, but there's a lot of volatility, so it's looking pretty good in terms of the finance space, as far as I can see. How to make job contacts. I don't know that I have a lot there. I think that there are actually quite a few, prop shops and tech companies out there, and getting in on in a smaller company, learning the ropes, learning the lingo, learning how things work, can definitely, having something like that on your resume will definitely stand out in terms of getting picked up by somewhere else. Midlife career change is interesting. Actually, one of the guys I work with very closely, I guess, I don't know if you'd be considered a quant. I think we call him our data czar. We've got a couple guys really that were originally engineers of various sorts, mechanical and chemical engineers. And this guy in particular went back and got his master's of financial engineering. And then, through that master's program, I guess his resume got in front of us and we brought him on. There's right, we have tons and tons of data to sift through. I mean, that's not a surprise to anybody. And, having those skills from the financial engineering degree has been really valuable. And he does, I think even on the trading side, we love to see people with a little bit of technology background. Like if you're a trader, but you can know a little Python, enough to be dangerous, that's fantastic. One of the efforts we're working on internally is exposing some of our backend APIs through sort of high-level Python stuff. I think that we have a spreadsheet now that some of the traders built that can feed parameters back into some of our curves, which it's fantastic. Right? Any leverage like that, where someone from a domain expert can use the system in that way is great as far as we're concerned. No, we definitely don't only hire younger people. I mean, we're actually trying to hire more younger people because a lot of our recent hires have been only fairly senior back-end people, which are great. But I think, at least from our perspective, hiring on younger people, it's going to take a few years before they're really sort of fully productive in building the kind of software you need. Whereas, hiring senior people is expensive, but they're going to kind of hit the ground running. Yeah, no, there's the other bullet point: how to hire a trader or developer. It's pretty tough. There's definitely, we definitely hire more traders than developers. It's interesting looking back at some of the early videos. I think there's definitely more of a math focus for traders. We definitely want people to be able to do fairly quick arithmetic. We actually do. I mean, even for fairly senior traders, we have them do basically a quick math take-home test. I think it's 10 or 15 questions on various subjects, and ask them to run the calculations in their head. And we're not expecting them to get 15 out of 15. We're expecting like 5 to 7. I think I could probably do 4 of them in the time allotted. Whereas we don't really give that to the developer candidates, especially the more senior ones. Like I guess we've been doing a fair amount of senior development hiring, and we're working more on getting more junior developers. Especially as sort of a mid-level options shop, it's one of the challenges that we have is attracting the right kind of people, right? Because we're not as flashy at the career fairs as like a Microsoft or a Google or a Facebook. And also, not as big as a jump trading or something like that. Do you guys have any more? Oh. All right, sorry, I got one more question before I change slides. Do we look for traders that already have their own strategies in place or ability to trade the firm's strategy? I don't know that, like when we're trying to hire someone, I don't think we're not really looking for someone with a specific strategy. We're not really asking what your strategy is. We're looking for bright people. I mean, a track record, yes, especially for senior people. But, we're looking for bright people who are going to bring new ideas and new ways to look at things. Does that answer your question? Yeah, okay. Well, I've gone too far. All right, let's talk about delta hedging for a few minutes. So I don't know the audience real well, but in general, right? Like, as you look, an option when it expires is either going to be in the money or not in the money. And you can use delta to sort of describe the chances of that happening. Right now, we only use FPGAs to cancel orders. Yes. We don't initiate any trades with FPGAs. We might at some point in the future move. We do have an electronic eye, which is sort of looking for opportunities in the market. We might eventually move that to FPGA. Right now, we've just in the last 6 months hired our first dedicated FPGA engineer. Right now we have an FPGA for the CME. We don't have an FPGA on either of the other exchanges, an FPGA canceller on the other exchanges. So that's sort of priority one.
Could you explain what FPGA is?
Sure. FPGA is a hardware device. Was it floating? I forget it's something gate array.
Floating point grid array or something.
Grid array, gate array, something like that. Anyway, the idea is, so you get an FPGA card and you can, they're fairly off the shelf. An FPGA is a reprogrammable hardware device where you essentially, you write code in a low-level language and flash the firmware onto the card, and essentially Whereas in a CPU that runs in your computer, right, all the gates are special purpose, right? That you've got an adder and a subtractor. Whereas in FPGA, there's a whole grid of repurposable gates, and you can, write code, flash it onto that gate, and have it do very specific purposes. It's essentially like you would be rewiring a device, except that it's a single device that can be repurposed to. You don't actually you have to get your soldering iron out. And so the advantages to FPGAs is that one is they're hugely parallel devices, right? Because if you're dealing with wires and electricity, you're not bound to the sort of single-threaded execution speed of a modern CPU. The other advantage they have is that they can run on they make devices which have an FPGA, which is essentially part of a network card. So you can have the FPGA observing 10 gigabit traffic from the exchange directly, and noticing patterns within that feed and sending messages back to the exchange in low double-digit nanoseconds. Whereas it takes longer than that. Do you think about the whole computer? Data comes into the network card, it gets decoded, it has to go across the PCI Express bus over to the actual CPU to get to main memory. And the FPGA can potentially have analyzed the state of the feed and sent a message back before that data would have even gotten to the CPU on the system. So FPGAs are really nice for some of that low latency stuff, right? Like if you're talking pure software, if you've got the fast network card, you've done kernel bypass, you really can't get tick to trade faster than about 5 microseconds in terms of even tick to trade or tick to cancel. Whereas with an FPGA, and even that 5 is going to have some noise in it, whereas an FPGA can sort of be rock steady at 80, 70 nanoseconds turnaround time. Yeah, that sounds really cool, Martin. I know for Globex, if you're talking about sandbox or their execution environment for Sandbox, it's definitely a little bit more used for futures. Sometimes it's a little sparse for options, so that's something to keep an eye out for. A lot of times when we do our testing, we actually wire up production market data feeds and then do cert execution, just because then there's a more realistic data load.
So we're talking here about a sandbox for market makers to test their systems. Is that correct?
I'm imagining this is just the regular either cert or new release environment. Is that what you're talking about, Martin?
Yeah, on the Chicago Mercantile Exchange, Globex, they have two. So they have their 24-hour electronic trading system called Globex, and they give you access to it. You have two methods of access. One's for Sandbox, developer account, and the other one's to actually do real live trading from your system, however your system is, from a spreadsheet or your box co-located at the Merck's data center, and on the switch or by the switch, or you can directly send your trades through Globex to do automated trading. And I'll mute myself. And thank you very much, Mr. Harding, for answering my question. And thank you, Mr. Brady, for holding this event. This is good.
Cool. I'm glad you guys are getting some out of it. All right, back to delta hedging. Yeah, so in general, right, you're trading, you're buying and selling options. You accumulate a position, an options position, and to hedge that, you take the delta, right? I mean, that delta may be, it might be, a handful of low delta options or some high delta options, but you accumulate that as delta in the particular product, and you send that over to the hedger. The hedger then, right, for each, one delta means you need one future, whether that's a positive delta or negative delta, you need to buy or sell a future. And right? So you need to you do that so that you're covered in case the, you know, when the option expires. And let's see. I mean, I think that's the way that is in the broadest possible terms is the way delta hedging works at most market makers, right? And then gamma comes into that because gamma is essentially how the delta on your options is going to change as the underlier moves, right? So if you bought and sold a bunch of options and you're like positive 10 delta, so you go and you hedge that delta in the futures market, then there's an underlying move, and now that 10 delta that you had in your option, you still got the same options position, but it's no longer worth 10 delta. Maybe now it's worth 5, so now you need to go sell off 5 futures to become back to delta neutral. And so I think that's kind of what the next talk is going to be talking about, is if you can model the positions of the market makers and how many outstanding outstanding calls and puts there are out there, you can estimate the gamma of the whole market. And if the gamma of the whole market is significant, then if there's a move, it's going to cause deltas to show up and need to be hedged. So I think that's going to be interesting. One thing that there's a lot of little tricks that you can do in terms of, or at least that we do in terms of, yeah, there can definitely be trade matches without a market maker. The market maker is just part of the market. In terms of lingo, I think when we call other market makers locals, and we call other traders paper. I don't know where those come from, but that's in general with market makers, we don't ever want to be trading with other locals, because that probably means that one of us has got our valuation off. Market makers do definitely play off each other a bit, right? You're just trying to, right? You're not trying to move the market. You're trying to work within the market, and everyone may have slightly different edges, but in general, the valuation models for market makers are pretty similar. If you see a large directional trade, that generally means it's paper, and usually paper knows what it's doing if that's the case. And then we try to adjust our models to account for that information. So Rick is asking how much of a position is hedged. So I think my last bullet point I call absorbing. So in an ideal world, you'd always be fully hedged. In reality, that would be fairly expensive, especially because as things bounce around, like you don't want to go, okay, we got plus 1 delta, minus 1 delta, plus 1 delta, minus 1 delta. If you executed all those trades, you'd end up with just losing money in fees at the end of the day. So there are settings that the traders can set. Like we have basically a band of absorbing. Well, let's say don't start hedging until you've accumulated at least 5 delta. So then as soon as we hit 6 delta, we'll try to hedge down to 0. But if you're just bumbling up to 3 and 4, you may be bouncing up and down there for a while, so you don't necessarily go to market with that. And again, that's a parameter that the traders control and can change during the day based on whatever they're what they're feeling about the market. Swapping is another technique. Like for example, we do a lot of treasuries, and a 10-year bond versus a 5-year bond are obviously very correlated assets. So if it comes in and says, hey, we really need to hedge a whole lot of delta in the 10-year future, but there's not a lot of liquidity there, we've got algorithms that say, well, let's try to convert that to what that would be in the 5-year and see if we can swap some of that and hedge it in the other market. Yeah, any other questions on delta hedging? Trying to think if there's anything else interesting to say here. we did try a little while ago to hire a guy who was a futures trader. He wanted to open a futures desk and just take the deltas from the options guys and trade them like a futures trader. That didn't work out, but it's not a terrible idea. We're not trading individual stock options. Yep, just SPX. We've got a couple other desks.
You mentioned you have natural gas, is that right?
Yeah, we've got natural gas, we've got treasuries, we've got indexes. Energies has been particularly interesting last few months. I think it was the person. Why did it not turn out that we don't now have a futures desk that is absorbing our hedging? I think we haven't found the right person. Is more than anything else.
So in a way, absorbing refers to taking a position on the market and letting that influence the degree of your hedging.
It does. Yeah. I mean, I guess it all comes down to risk, right? Like you want to be as risk neutral as possible. And the other thing, if you can, if you're looking at the E-mini, it bops up and down quite a bit. So a lot of times what you're trying to do is, rather than just immediately crossing the bid-ask spread, if you just hang out on the side, and wait for the market to come to you, that's often, you can save a few ticks here and there. And it's about quarter till. Don, I don't know if you want to take over.
Well, let me just make a couple of points. Yes, thank you. That's fantastic talk. I love it. First of all, does anyone have any questions right away for Eric?
Looks like a couple other questions come in. How do you make money as a hedger? In general, we don't. In general, for a market maker, the hedger is sort of seen as a cost center. Right. Like minimizing loss, I think is what our goal is. How do you select new markets to make markets? That's an interesting question. I think that it's, kind of the size of the opportunity, as well as our firm tends to do very well in pro rata markets. So, moving into other pro rata markets is a little bit easier. So you sort of understand the technology there.
What is a pro rata market?
All right, so there's a FIFO market is sort of the traditional market where, orders are executed in the same order that they're put in. So if you're the first in line and somebody matches with you, you get matched. Whereas a pro rata market, there's if there's, say, 100 options on the bid and somebody comes in and wants to buy 50 of them, then instead of just taking the first 50 in queue, there's usually a pro rata segment of that trade where they'll say, okay, well, there's 3 market makers here, and this one had 50 on the bid, and that one had 20. So we're going to give a certain a larger percentage to the one who was showing more size.
Huh.
It's probably the worst definition of pro rata. And the different products have different rules about that, but it's really an incentive from the exchange to get market makers to show liquidity there. And usually it's not 100% pro rata or 100% FIFO, right? Usually your queue position is taken into account. And then you get so if you're at the front of the queue, you'll get, maybe 50% will be given to queue position, and the other 50% will be pro rata. So they'll take the aggressor order and split it up that way and divvy the fills.
So that's part of the I would guess that's part of the contract you have with the exchange.
Well, it's part of the contract with the exchange, but it's also sort of part of it's done. It's based on the instrument.
Sure. Wow, that's fascinating. Well, ask any more questions if you want we got them here of Eric. And otherwise, I'll start to go into just a brief introduction to the, oh, is there an existing portfolio you try to hedge?
Only if we crash. No.
Well, see, they have to hedge. You were trying to hedge.
I mean, in general, there's always an options position. And as that position changes during the day, that's what we're trying to hedge.
So it's always a delta normally, but you say if you crash, then you have to re-hedge, I guess.
Well, yeah, I mean, if the hedger crashes, for example, and then it comes back and it missed some messages from the quoter, sometimes the traders can manually enter and say, well, it looks like we're not hedged where we want to be, so they can sort of manually feed deltas into that position.
Wow.
I missed the first 7 minutes of the webinar, so I just had a couple quick questions. Are you guys market makers? Are you with a particular?
We're market makers.
You're market makers. Okay, that makes sense. So let me lower my hand. So you guys, most market makers, which people aren't probably aware of, the exchanges provide what's called, they have these liquidity programs where if the market makers make so many voluminous trades, like 1 million trades a day or something like that, just to give you guys an example, everybody an example, what happens is they get refunds on the exchange fees. That's how they live. So they might not scalp, but scratch 1,000 trades a day or whatever. But because they made the market so tight and efficient, they'll get, per a certain quantity of trades per day. They have these, what they call like liquidity programs that essentially the market makers provide liquidity to the retail traders and the brokerages. So that's another revenue stream for them. That's all I wanted to say.
Yeah, and I think that's definitely true. Like right now. So Brian has a question: when do you take off deltas as the options are expiring? I'm not sure that I can answer that question exactly. We definitely have an expiring procedure, but I couldn't really tell you the details. Rick asks if we can add liquidity to RUT. Sorry, we're not trading RUT right now, as far as I'm aware. All right, if nobody has any more questions.
Okay, well, let me ask you a couple of questions. They have their own risk. The exchange has their own models of risk. I believe, what is it called? I forget now. Or for pricing. For margins, they have margin. Does that affect you?
C-SPAN.
SPAN. That's right.
Mm-hmm.
And an alternative measure that has been recommended in recent years is VAR, and also unrecommended. Do those affect you at all, or do those come into you?
I'm familiar with SPAN. I'm not familiar with VAR.
Value at risk. Maybe
Yeah,
that's more a portfolio.
I mean, the exchange definitely does have sort of their own model. We call it haircut for some reason, but essentially they're saying within, like, we don't necessarily trade with exactly their model, but they maintain a model of our position. So that there's checks and balances there that you're not going over your credit limits as you're trading. And we definitely have a risk manager who is watching those values pretty carefully. And there's occasions where our model says we're doing something safe and theirs doesn't, and sometimes we have to go argue with the exchange and be like, no, look, our strategy is sound, we're good. But But yeah, I mean, at the end of the day, the exchange will always win that kind of argument because they're the exchange.
Yeah, I think there's this huge controversy over whether VAR is better than SPAN, and people want to switch from SPAN to VAR, and either of them is vastly superior to the legacy horrible margining systems used for stocks like Regulation T.
Yeah, I believe that.
Which is sort of based on maximum loss and things like that, which is not a good risk measure. Mark has a question there.
I would have to go ask somebody. I don't know.
Slowing theta decay. That again, Mark, will be a good question for our next talk in the second hour, because I believe the extent, the effect of time on delta is called charm. Is that right?
I'm not. Maybe.
That's correct. That's correct.
Thank you very much. Would you like to explain that a little bit?
Doing good, but what I wanted to just say real quick, in part to answer his question, Mark's question, is the exchange controls the theta decay as far as whether it's positive or negative per day, per option. So that's not really something within the realm of control of traders. It's just something it's a result of the positions that they hold, that we all incur theta decay or not. But as far as who controls theta, the pricing of it and all, that's all controlled by the exchange.
And well, I won't. I'll just take that reply. I think we need to emphasize something. We're coming up to 8, so I won't start in anything major, but I think we need to emphasize for people that here we're talking about the Greeks. And people are used to evaluating the Greeks of their own portfolio and their own trades and their own strategies. And this is really a completely different use of the Greeks that we're talking about in this meeting. We're talking about looking at the overall gamma position. That's the main one we're looking at of the market. And you can calculate every day the gamma of individual strikes all across the instruments, the markets. And that's what our next speaker is going to talk about, and look at that as a guide to how the market will behave under certain stresses, under certain events, under certain shocks. And it's how to trade that market. And it turns out it's very, very different how you want to respond to that, depending on whether gamma is positive or negative. Let me just, while I'm looking to see something, what is the significance of a gamma being positive or negative? Eric, do you want to comment, or else anybody else?
I mean, if you've got a large gamma, positive or negative, as the market moves, it's going to translate into having more deltas or less deltas.
So this is the famous manufacturing of deltas that we hear referred to, and which gives the exponentiality of a position in terms of its value, or convexity, right?
Mm.
Would anyone like to define convexity? Let me just see. Oh, Brent is here, I see. So let me thank you very much, Eric, for that excellent talk. And let me just stop the, you might unshare if you could, please. Let me just,
I think I did.
Thank you. Stop the recording.